Hi and welcome to Swissquote's Daily Market Talk. It's Friday, November 22nd. Nvidia survived to lack of enthusiasm from investors following a few red flags from its quarterly report earlier this week, but mood among big technology companies was less cheery with the DOJ forcing Google to sell Chrome. On the geopolitical front, the escalating tensions with Russia boost energy and gas prices right now and threaten to revive global inflationary pressures beyond Trump and interfere with central banks' easing plans. So moodiness due to a lack of a strong post-earnings rally from Nvidia remained short-lived yesterday because investors rapidly shrugged off the company's warning that the profit margin will dip to 73% on manufacturing challenges of the Blackwell chips and simply thought that they could cope with that small deterioration. So the shares fell well short of the 8 to 10% rally that the market was prepared for and posted a meager 0.53% rise post-earnings. But nevertheless, the stock price hit a fresh all-time high level yesterday, even though the move was far less than impressive. Now, Nvidia couldn't offer the major US indices a fresh record high yesterday, as big technology companies were mostly sold yesterday, led by a 4.5% sell-off in Google due to the DOJ's demand to sell its Chrome. But both the S&P 500 and Nasdaq 100 gained yesterday, the day after the Nvidia reported its quarterly earnings and consolidate near their all-time high levels. And Bitcoin is just about to clear the 100,000 level psychological resistance. Now, as per Google, Chrome is obviously extremely well integrated into Google's ecosystem and provides Google, that holds nearly 90% of the global research market, with incredibly precious information to collect on customer data and feed it into its advertisement business and into its AI models as well. So if Chrome is taken away from Google, the company will lose one of its most powerful arms to compete with its AI rivals, and also could lose field against OpenAI, for example, which has now become one of the go-to platforms for those who are willing to conduct a research on the web by chatting with an intelligent bot. So it is needless to say that it would be a disaster for Google to lose Chrome at such a critical and strategic time. But zooming out of Google, well, the earnings season in the US gently comes to an end with a stronger than expected performance for most of the S&P 500 companies, because 8 of the 11 sectors in the S&P 500 posted earnings growth last quarter, showcasing a broad resilience despite the macroeconomic challenges that investors were fearing of. Energy companies continue to face challenges due to weak oil prices, but the big technology companies have been a standout, and the overall earnings actually proved better than the market expectations. So the numbers didn't point at any type of economic distress in the US. On the contrary, they maintained the soft landing narrative, also supported by broader macroeconomic data in the US, well alive. Now, of course, the strong economic growth is certainly good news for businesses, but strong businesses are not necessarily good news for taming inflation. And add to that Donald Trump's plans to cut corporate taxes and impose tariffs on China, but also on other trading partners. While the inflation outlook for the US doesn't look supportive of sustained interest rate cuts from the Federal Reserve. As such, the US yields will continue to feel the pressure of this uncertainty regarding what the US Federal Reserve should do in its December monetary policy meeting. The probability of a December rate cut from the Fed improved to 60% as the continued claims in the US rose to a 3-year high, but the Fed's decision is more close to call than many think, in my opinion. In the FX markets, the US dollar is extending its rally these days and is not necessarily on the Fed expectations, but mostly on a fair amount of safe haven flows, safe haven demand for the US dollar amid the mounting geopolitical tensions in Ukraine. So the latest news on the wire actually suggests that, and I cite, Russia launched a new kind of ballistic missile into Ukraine as a response to Ukraine's use of US missiles on Russia earlier this week. So this latest escalation of tensions between Ukraine and Russia results in fresh sanctions against Gazprom Bank, which was so far the last major Russian financial institution that wasn't concerned by the earlier sanctions, as well some European nations out here continue to pay their gas purchases from Russia via this Gazprom Bank. Now, they can't anymore, and funny enough, the news lands at the very first day of snow in Switzerland, warning that even though Europe, which will be cold this year probably, has a reduced exposure to Russian gas, cutting whatever was left of the Russian gas supplies will reduce the amount of supplies on the continent and threaten to boost gas prices. So the European gas futures show an accelerated rally this week on the situation, while the US gas futures are exploding to the upside on the news. So US nat gas broke above the summer peak levels and this time around has probably taken out the $3 psychological resistance level sustainably. The upside pressure won't be comparable to what we saw in the early days of the Ukrainian war, but this tense geopolitical environment has actually the potential to push the natural gas prices toward the $3.50 and $3.60 range, which is the January peak levels. Now, elsewhere in the energy markets, the escalating tensions between Russia and Ukraine gives a hand to oil bulls this week. The barrel of US crude has stepped above the $70 per barrel psychological resistance, but faces a thick layer of offers between the $70 per barrel and $73 per barrel range. Because the combination of weak global demand and ample global supply in oil keeps the macro focus bears in appetite near the actual levels. But the current environment is turning increasingly positive for the tactical longs and the US energy companies as well that will see the additional opportunity to increase their market share in Europe. In the FX markets, while the US dollar's recent rise pushed the euro dollar down the 1.05 cliff at yesterday's trading session, and cable extended losses below the 1.26 mark, investors will be watching the flash PMI figures from the Eurozone and the UK this morning to figure out how to rectify their ECB and their Bank of England expectations and also their euro and sterling positions. But the major driver of the FX market right now is and will likely remain the haven flows that favor the greenback against major peers. This being said, the solid appreciation that we see in the US dollar these days, combined to the rising energy prices, will likely ring the alarm bell among the ECB and the Bank of England those and get them to tame their dovish expectations. So the latter will probably support a recovery in both the euro and sterling once the geopolitical dust settles. Therefore, I would be mostly looking for interesting dip buying opportunities at this extended sell-off levels rather than strengthening short positions against the European currencies in favor of the US dollar. In Japan, while inflation fell to the lowest levels in 9 months, but came in stronger than expected by analysts still, so the latter boosted the Japanese yen purchases earlier at today's trading session, but the broad-based US dollar strength and this little conviction from the Bank of Japan hawks regarding the policy normalization should continue to support a further rise in the dollar yen toward the 155 level and above. And I believe that the US dollar has a bigger upside potential against the Japanese yen at the current levels than against the European currencies. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. So I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.